In this week's video, we'll address the important question: are we seeing signs of an important bottom in stocks? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Experienced traders will tell you that these bullet points here tend to be important near possible and probable reversal points. On our chart, we'll show you that the S&P 500 held at a logical level twice on Friday when we had the big reversal. Volume picked up significantly on SPY. Early numbers say it finished about 42% above an average day if you look back 3 months. The market, if you look at an intraday chart, it really wasn't volatile intraday. The climb was pretty steady. We rose, consolidated, and rose. And we can also learn something intraday. Once we got green, sometimes you get a huge reversal, you get green, and then almost immediately go red again. That didn't happen. We stayed near the flat line, consolidated, and then we had a very, very strong close. Instead of getting red, the market improved after that and closed well above the flat line for the day. We closed near the high for the day and for the week. Both of those are relevant. We'll cover some observable improvement in the model and candlesticks. Advanced decline line on Friday was better. Not outstanding, but better. 73% of the stocks on the NYSE advanced, 66% on the NASDAQ. A strong intraday reversal happened twice this week above a support level that we'll show. We also had a strong intra-week reversal. We were down significantly intra-week, closed green for the week above a support level. All of these things speak to improving probabilities, and they'll be offset by the concerns that remain, and we'll cover those too. Balancing things out, last week stocks were really up for 2 days. 2 of the 4 days were basically flat. So to put that in some perspective, 2 to 4 days relative to the fact that the S&P 500 peaked 134 calendar days ago tells us that we still need to keep this move in perspective. It's been bad for quite a while, and we've seen some improvement. Heading into the week, did we miss out on this bottom? No, intra-week, the S&P 500 was still this week down over 12% from its recent high. The NASDAQ this week, intra-week, was down over 14% from its recent high, and the Dow from its recent high to the intra-week low this week was down 13%. Small caps using the same peak to trough, 16% this week, and biotech intra-week was still down 28% plus from its highs. All of this tells us that if an important bottom is being made, and we don't know that, we're able to re-enter at a better risk-reward entry point. This is one of the weekly charts used by the CCM market model that regular viewers are accustomed to. We've just blown it up this week to focus on some things. I know this is noisy, bear with me. We can point out what we're trying to show here. A few positive developments. This T here shows you where price closed, right here where my cursor is. And then 2 weeks later, we closed here where my cursor is. This shows you that that's a lower closing low, and we had a positive or potentially bullish divergence starting to take place on Williams percent R, which is momentum. We don't buy that under our system. All it does is tell us to pay closer attention and helps us to keep an open mind as long as the divergence is in place. We can counteract that with something else that we'd like to see improve. CCI, or the Weekly Commodity Channel Index for the S&P 500, has not left oversold territory yet. We'd really like to see that if we're going to get a sustainable rally. We also got the retest that we've been talking about this week. It appears to be a successful retest. It's too early to say that, but that's just first blush. This shows you the low, intra-week low here. This week we had a very, very scary retest. We came down basically to the same level and made a little bit of a higher low and reversed. And this tells us that we closed at the session high. That's a good sign. Price, this is the T, this is where we closed above the blue moving average for the first time since August. That's observable. We can see it. It's different. Doesn't mean a bottom's in. No, what it means is things look a little bit better now than they did a week ago. That's all it means. The risk reward in this chart is a little bit better this week at the close than it was last week at the close. Therefore, if you're a client, that's why we took an incremental move back towards risk. The model at the end of the week asked the question, are we properly aligned given the hard evidence in front of us? At the end of the week here, it was no. We were a little bit underallocated. Nothing radical. We need to see more. That may come next week. It may not come next week. And the way we handle that is we made an incremental move. If we're right on the equity side, we can take another step if the evidence improves. If we're wrong, we understand that any incremental move could be wrong. We just won't take the next step. The market will decide. The market model looking at the hard data will help us decide. If you're a client, a fair question maybe, Chris, if you saw improvement, why did we take a relatively small incremental step or add to the equity side? That is a fair question, one that we will address now. Regular viewers know these are our weekly charts. There's no magic moving average or magic moving average pair. So the CCM market model diversifies and uses multiple time frames. These moving averages are a little bit longer in duration than the previous weekly chart that we just looked at. This, as regular viewers know and clients know, is a full bore bearish look with price below all of the moving averages. The slopes on all of the moving averages are down. In blue, the fastest moving average is on the bottom. When things improve as they did in 2009, the look changes. Now price is on the top. The slopes of all of the moving averages are up. And instead of blue, the fastest moving average being on the bottom, as it is here on the left, it's on the top. How does the exact same chart look today? And what is it telling us about how fast we should be scaling in? The answer is this is still a full bore bearish look. So when the model asks questions about this time frame, they're still coming back with concerns. And as we've talked about before, bottoms can be a process. So we may need to move up in this direction, consolidate. We may move around. We don't know if today was a bottom. We do know this with certainty. There was some observable and incremental improvement that took place this week. As you can see here, on some time frames and by some measures, the improvement was not significant, and there is nothing really to observe here. One thing you can take away is SPY finished the week up over 1%, and it made a higher low. During the session on Friday, we were on track to make a lower low. That's a pretty significant reversal. If we've made a bottom, we will see observable improvement on this chart and in other areas tracked by the market model. If that happens by rule, just as we did today, it won't be a decision. We are forced by rule to scale back in, which is exactly what we did on Friday. And we're open to doing more of it if the gains from Friday hold and the evidence continues to improve. Next week, the evidence would begin to improve at a faster rate if we're green all week. The model will then scale in at a faster rate. When the evidence improves rapidly, we scale in faster. When it improves in a small and incremental manner, as it did this week, we scale in at a slower rate. If you follow us on Twitter, you might have noticed on Thursday evening, I believe it was, we tweeted out a version of this chart that said we might learn something about risk relative to this level here on the VIX Fear Index weekly. When we tweeted the chart, the VIX was above this line and holding this fear breakout. The market model does not rely heavily on the VIX, but it does use the VIX in several places. Doesn't carry a big weight, but it's there. This is one of the charts that the model asks questions about. We did learn something from this chart. We did not hold this fear breakout here. We closed below it. We're still in this area here, so like other things, we're not necessarily out of the woods on this chart, but we can see some incremental improvement. The VIX was down 11% this week. We'll keep an open mind about this chart and every other chart next week. This is one of the daily charts of the S&P 500 that we've been using the past few weeks to help us navigate through this volatile period. Let's cover some pros and some cons here because we have both. First and foremost, the market made a stand at a logical level. October low here. This slope matches this slope. The market cares about the slope here, 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 and now here. And one of the important things here is we had those sharp reversals intraday twice this week, and then also intra-week, and it occurred near a logical level. Does that tell us that this is going to hold? It doesn't tell us that at all. It just simply tells us that the probability of it holding is much better than it was a week ago. Let's talk about some of the negatives for a moment. Has this chart made an important higher high? No, it hasn't. It's made a relatively minor higher high. This is an intraday high here, higher than this high. And it's also pairing that with an intraday low that's a little bit higher than this low. So those are positive developments. But we still have this primary trend to deal with here, and we still have to overcome all of this here, which is why we take an incremental step. From a positive perspective, these are very powerful looking candlesticks. That's also a good sign. We will review this chart next week with a flexible, unbiased, and open mind, respecting that there are some negative hurdles, relatively big hurdles, for the bulls to overcome. Here's some candlesticks this week that also told us to be open to a potential bottom and a rally here. This is small caps IWM. You can see small caps have had a very, very rough time of it since about mid-July. Here, I know this is hard to see, so maybe you can pull this up on your own. IWM, this is a daily chart. Here's a body right here. This is what's known as a bullish engulfing. It's very, very similar to what happened today. This tells you that back in October, the market had a wide range, and then it closed with a very, very clear bias to the buy side. That's what the white means. And this part of the candle is engulfing this part of the candle. And what happened here is basically the same as what happened today. we had a big intraday reversal in sentiment, and we closed in a powerful manner, telling us that the probability of good things happening had increased, and indeed stocks rallied. We have a very, very similar look today. It's just one piece of evidence that says we should keep an open mind, and it did make it easier to follow the rules and scale in a little bit on the growth side. We could probably find numerous examples of these candles. You can see a small body at the October low, a bullish engulfing the body, engulfs the body, telling us that the probability of good things happening has increased. We have the same thing here today. That's bullish engulfing. Another thing that we had happen today, bonds, as we showed, did well. In fact, bonds were green on Friday. Does that make sense? Yes, it makes sense. The weak employment report tells us that the probability of the Fed raising rates in the short run and doing it in a successive manner quickly, all of that's lower. Makes sense. We saw a reversal in this. This ETF pays a dividend, and therefore it has some bond-like characteristics relative to the market's perception on interest rates. Similar concepts here. We get a nice looking candlestick at the low in October on IBB daily biotech, and then we rally. This in isolation does not mean we were going to rally. It's just one piece of evidence. Nice bullish engulfing here. Big reversal in sentiment intraday. Overshadows, engulfs this small body, up 3.47%. That's the good news. The bad news, the trend, 22-week moving average, is down. We haven't made any firm higher high yet. So this has work to do, and again shows why we took an incremental step in line with the improvement that we saw. This could still go either way, thus the flexibility and open mind. Let's assume that we had a crystal ball, and a week ago, the previous Friday, back near the end of September, let's assume we knew that this big intra-week reversal was coming, and we dumped our bond positions and bought SPY, a more aggressive bond stance in junk bonds and small caps. You would think that we would have been rewarded greatly this week. The answer is no. Bonds performed better over the full week. SPY lagged IEF from Friday to Friday by 0.39% this week. So IEF didn't hurt us this week. It helped us relative to the stock market. TLT trounced JNK by over 4% this week. And this is hard to believe, and also tells us that we should keep an open mind about all outcomes still, including bearish outcomes. As of the close, the tally for the 5 trading days, IWM or growth-oriented small caps, lagged defensive-oriented TLT or treasuries in the ETF world by over 3%. So what this tells us is that we really didn't miss a whole lot with those positions. And if this starts to change, which it very well may, over time, the rules will require us to rebalance there. For now, that's not likely that we would see enough improvement that would say we would have to dump our bonds. And with the employment report that came out Friday, intuitively it makes sense that bonds may be okay. The probability of the Fed hiking rates is lower today, and the probability of them hiking back to back to back is even lower, which is more important for bonds. So do we know whether or not a bottom is in? I won't even answer that question, because under our system, we don't need to know. We know that we saw some improvement and we adjusted to that. If we make a bottom, we'll continue to see improvement and we have to adjust to that. If this was a 1-day, 1-week wonder, Then we took a small incremental step, and we're still in good shape. So we'll head into next week with that flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.